Alright, let's dive into something that's been making waves in the crypto world lately, the Coldcard wallet exploit. Now, if you've been following the news, you know this isn't just another hack story. It's a moment that's got analysts and investors alike rethinking how they approach Bitcoin custody. But here's the thing, I think this goes way beyond just a security breach. It's a catalyst for a much bigger conversation about trust, regulation, and the future of crypto adoption. Let me break it down for you. First off, the Coldcard exploit itself is a gut punch. We're talking about $114 million in Bitcoin drained from over 5,200 addresses. That's not pocket change. What makes this really interesting is that these weren't your average crypto newbies getting hit. Many of the affected users were following best practices for self-custody. They did everything right, or so they thought. And that's the kicker. It's a stark reminder that even when you're doing everything by the book, there's still a level of risk that's hard to eliminate. Personally, I think this exploit exposes a fundamental tension in the crypto space, the trade-off between control and security. Sure, self-custody gives you full control over your assets, but it also means you're on the hook if something goes wrong. Now, analysts are saying this could actually boost demand for regulated Bitcoin products, like ETFs. And honestly, I can see why. For a lot of investors, especially those who aren't tech-savvy, the idea of managing private keys and firmware updates is a non-starter. They just want exposure to Bitcoin without the hassle. ETFs offer that. But here's where it gets fascinating, this isn't just about convenience. It's about trust. When you buy into an ETF, you're trusting a regulated institution to handle the technical stuff. And in the wake of a high-profile exploit like this, that trust becomes even more valuable. In my opinion, this could be a turning point for institutional adoption. If regulated products can position themselves as the safer alternative, they stand to gain a lot. But let's take a step back and think about the bigger picture. What does this exploit really suggest about the state of crypto security? One thing that immediately stands out is how vulnerable even cold wallets can be. Cold storage is supposed to be the gold standard of security, right? Yet here we are. This raises a deeper question, if cold wallets aren't foolproof, what is? I think what many people don't realize is that security in crypto isn't just about technology, it's about human behavior, too. Even the most secure system can fail if there's a flaw in the firmware or if users are tricked into compromising their keys. So, while wallet providers will likely ramp up their security measures, the truth is that there's no such thing as zero risk. And that's something investors need to come to terms with. Now, let's talk about the companies that could benefit from this shift. Analysts are pointing to firms like Robinhood, Coinbase, and BitGo as potential winners. Why? Because if more people move away from self-custody, they'll need somewhere to park their Bitcoin. Managed custody providers are the obvious choice. But here's the twist, I think this could also accelerate innovation in the security space. If wallet providers want to stay relevant, they'll need to up their game. We could see a wave of new products and features designed to reassure users that their assets are safe. From my perspective, this exploit isn't just a setback, it's a wake-up call for the entire industry. Finally, let's zoom out even further. What does this all mean for the future of crypto? Personally, I think it's a sign that the space is maturing. Every major hack or exploit forces the industry to adapt and evolve. This time, it's about balancing the decentralization ethos of crypto with the need for security and trust. Will we see a mass exodus from self-custody? Probably not. But I do think we'll see a shift toward hybrid solutions, where users have more control but also more safeguards. And that's not a bad thing. If you take a step back and think about it, this exploit could be the push the industry needs to build a more resilient and inclusive financial system. So, here's my closing thought: the Coldcard hack is more than just a security breach, it's a mirror. It reflects the strengths and weaknesses of the crypto space today. And how we respond to it will shape the future of Bitcoin and beyond. What do you think? Are regulated products the way forward, or is self-custody still the way to go? Let me know in the comments below. Thanks for watching, and don't forget to hit that subscribe button for more insights like this.